Let's begin with roll call. John Vischer, a belated joining member.
Matt Barker, member.
Harvey Lewis, member.
William Johnston, staff.
Cynthia Ramos, staff.
Mark Benton, staff.
And I think Dave said his name, but was on mute.
Okay. All right. Okay, everybody. Okay, so we have an agenda for our meeting for today, October 29th. I'd be very happy to entertain a motion to accept the meeting agenda as proposed.
This is Harvey. I
So moved.
Great, we have a motion and we have a second. Motion initially by Harvey, seconded by Matt. Thank you very much. We also have approval of the minutes from our last meeting. I appreciate a summary of a rather lengthy discussion. Any amendments to the minutes as presented? If not, again, I'd be happy to entertain a motion to accept as presented along with a second.
So moved.
We have a move. Do I have a second?
Second.
Great. Thank you very much. All right. We have our minutes been approved. Bailey Gifford, gentlemen, you guys are, I believe, on the line. We got a very, as usual, very well put together presentation for you guys, as I mentioned before. Of all the money managers I deal with, you guys do the very best of visually presenting the information in a clear and concise manner. So I'd love to steal your marketing person. They're doing an excellent job. So thank you.
Thanks, John. Yeah, I can only pass on the thanks to our colleagues in the artwork team. They do help us a lot, and it's really great to work with the materials that they put together. So I'll pass on your comments. Thank you very much, and thank you everybody for the opportunity to catch up again. It's always a pleasure. My name's Andrew Murray. I'm joined by my colleague Kevin Fenelon, who's also on the line, and we're delighted to have this opportunity and give you an update on the portfolio. It's been a year since we were at the sort of formal PRC setting. So I just wanted to start off with a couple of points, and then Kevin will kind of kick in with the portfolio update. Obviously, we wanted to share our deepest condolences around the sad news of Brian Sargent's passing. Not just from Kevin and I, but Brian had met a number of people from across the team, and they were all really upset when they heard the news. Brian was an absolute gem, and we really enjoyed working with him over the years.
Well, thank you.
We're also reflecting on the call we had at the start of October with some of your other managers when you were talking about asset allocation questions and kind of the outlook in terms of markets and portfolios. If there's anything further we can add to help with that conversation, please let us know. Obviously, we're going to sort of talk about the broader picture in terms of the portfolio, but if there's any follow-up questions on that, please do sort of raise that with us now. Or indeed after the call. And additionally, just in terms of housekeeping, you will hopefully be aware that we had what we called a What Next Zoom call across our client base at the start of September, I think it was. And I think Chris clearly was on that call. I can't see Chris on this call just now, but I think Chris joined. I'm not aware of anybody else who did, so apologies if you were also on the call. We shared the write-up from those calls with the presentation and the questions and answers that followed. I had 4 members of the portfolio construction group, and they talked about some of the recent returns, which have been a little bit abnormal. Some of our analysis and reaction to those returns to sort of set some context and what we've been doing on the back of it, and some forward-looking comments on the areas that we think are of most interest in terms of research and opportunities going forward. And we'll touch on some of those aspects obliquely just now, but that was all shared in the write-up, which I hope you found helpful in terms of what's been going on this year. So without further ado, I'll hand over to Kevin to provide some comments on the firm update and the portfolio update, and then I'll follow up with some comments on the thematic slides that follow in terms of the pack we shared. And has everyone got access to the pack that we sent out?
Yes.
And the picture of that beautiful city. Now, I'm just assuming that's your corporate offices, alone.
The whole thing.
Yeah. Okay.
That's the Royal Mile itself. It goes from Holyrood Palace up to the castle. So that's the historic heart of Edinburgh, but it's not a million miles away from our office.
Okay.
Great.
And looking, are you at home now, remotely working?
Yes. We've been working from home continuously since March, and I think when we all went home, we expected to be back in the office at some point. But and Kevin will let you know kind of the numbers of staff in the office right now. But we don't expect to be going in anytime soon. It'll be sometime into next year before that's going to get scaled up.
Great, thank you. Okay, I don't want to disturb your presentation, so please continue.
Right, thank you, Andrew. I'd like to say that's the view from my front room, but that would be a lie. It's not.
Okay.
And Andrew's been very modest when it comes to the handout and the packs we put together. It's in the client service team, Andrew is our most creative person, so a lot of it's down to him. But that's the last time I'll be polite about him in this call. Let me. And please just stop me at any time and ask questions as we go along, and hopefully we can be as interactive as possible. I thought a firm update might be useful for you, given the circumstances in which we all find ourselves. And I'm happy to say that despite the various forms of lockdown that we've had in the UK since the middle of March, the business has been performing on a business as usual basis through the COVID crisis. What I mean by that is all the key functions such as client reporting, administration, regulatory and compliance, trading, and of course the investment research function, all those have been performing on a regular and normal basis. And you'll also be very well aware that we've been fortunate enough to generate some strong performance through the crisis as well. Where we are right now in terms of logistics of it all, we've got a staff of 12 or 1300 in total at Baillie Gifford. At any one time, there's about 50 to 60 of those in the office, all under strict protocols, one-way systems, cleaning system, all this sort of stuff. But to be honest, it's hard to see us being back in any material way, certainly before the new year. So most of us, the vast majority of us, are continuing to work from home. But with services like Teams and Zoom and what have you, we're finding it's working pretty well. So as much as possible, business as usual at Baillie Gifford. One part of that business as usual is investing for the future, and one of the key investments we make for the future is the investment graduate program, which takes place every year. This year we've got 13 investment graduates who just joined us about a month ago. And of course, it's quite an interesting induction period for them. It's all been done remotely, online, little opportunity for them to be in the office to absorb the culture. So it'd be interesting to hear how that works. Normally we've taken on 5 to 10 per annum, but the quality of the applicants this year, of which we get a few thousand, is high. So we've taken on 13. One of them has found himself in the strategy in which you're invested, the international growth strategy. A young chap called Douglas Jack, who's got a degree in history. He's joined the international growth team as part of his training program. And as you'll remember, our graduates rotate around various investment teams over the first 5 years of their employment at Baillie Gifford. So Douglas will be on the international growth team this year, following which he'll rotate off somewhere else, and we'll get somebody else in. Sort of a very junior level people move around the teams to get a broad range of experience. And then a couple of strategies just want to sort of highlight, which we think are interesting. We recently launched our Health Innovation Fund, which is a fascinating one. It's a thematic fund at the intersection of technology and healthcare. In your portfolio and the international growth strategy, the healthcare weighting has been creeping up over the years as we found more opportunities to invest in this type of stock. And I would expect that to continue over the coming years. But we think it's such an exciting area. We launched this standalone fund, and that's reached about 150 million US in total, and has won its first external client recently. So we hope to be talking more about that in the coming years. And then on private companies, we've now got about $5 billion US invested in private stage companies across a range of funds for a range of clients. And indeed, in your portfolio, there's a handful of stocks that were once private that we invested in as private companies that have subsequently gone public. And a couple of years ago, we launched a UK listed closed-end vehicle, a standalone vehicle, which, to be honest, is a relatively unfamiliar structure for US investors. So one of the things we're thinking hard about at the moment is how to structure something that would be more familiar for our US clients to enable them, if they were interested, to invest in late-stage private companies with us. So again, hopefully over the coming months, you'll hear more about that, and we'd love to have a conversation about that at some point. So that's a Baillie Gifford update. Does that generate any questions, or should I crack on to the portfolio?
No, please go ahead and track on to the portfolio. But thank you for that update.
Thank you. Okay, on the next page, then you'll see the portfolio as usual listed by, organised by holding period. So on the left-hand side, 21% of the portfolio has been there for over 10 years, and on the right-hand side, 9% has been there for less than 2 years, with the rest in the middle. So that's how we present the data. I think that the top-down comment is that we are very happy with the operational performance of the portfolio in aggregate, and critically with the growth prospects from here. And Andrew will be talking more about that in a few minutes. It's been a testing period for many companies, but one of the reasons that the investment performance has been so strong recently is that the key contentions that inform this portfolio going into the crisis have held up very well, and indeed have been enhanced. Those were three, and it's worth repeating them. One is essentially the power of technology across a wide spectrum of the economies around the world, but particularly the digital economy. And as we know, just about the whole planet has moved online in various ways through this crisis. So that's one thing. The second thing is the power of China, and we think that is an inexorable rise. It will continue, notwithstanding the politics between the US particularly and China. We think that rise will continue, not without its challenges, but fairly inexorable. And the third one is the desire to create a concentrated portfolio of companies that can produce outsized returns for you. So we're looking for outliers, potential for multi-baggers in the portfolio. A quick 30-40% here and there is not what's of interest. What we're looking for is companies that can grow to a multiple of their current size. So when our researchers are doing their job and thinking about companies and whether they deserve a place in the portfolio, that's what they're thinking about. They're not thinking about, can we get 50%? They're thinking about, can this company be 2, 3, 4, 5, 10 times the size it is currently? So that's what's driving the research effort. So those contentions remain and are still key components of the way the portfolio is structured, and we think are the key reason why the portfolio has done so well recently. I won't go into all the buys and sells, but just to sort of decode what you're looking at. The little blue, red, and green sort of circles next to company names either mean fairly self-evidently either mean an addition, a reduction, or a new buy. And there's 3 of the new buys at the bottom right-hand corner. They're all, interestingly, they're all Antipodean stocks. 2 are Australian, and one is from New Zealand, and that's just a coincidence where they happen to come from. One, Afterpay, is a financial stock that we think is really very interesting, and the other two, Xero and WiseTech Global, are cloud software stocks providing software services to enterprises, but in the cloud. And we think the cloud has a long way to grow, both in terms of personal consumption, but also in the enterprise as well. So those are 3 pretty exciting new holdings, which we would hope to grow over time. And on the complete sales, there's nothing too much I want to say about those, other than the fact that the reason we've sold them is for fundamental reasons, which is that we think the growth prospects are now not worthy of a place in your portfolio, bearing in mind the comments I've just made about looking for high growth stocks. So these are not necessarily anything wrong with them as companies. They just don't meet the hurdle rate for growth that we're looking for. And then before I hand over to Andrew, just moving on to the next slide, slide 3. This is called Portfolio Resilience, Coping with the Coronavirus. And this is one of the first things we did when the coronavirus appeared in the Western world and we all went into lockdown. What we were trying to do is look at the portfolio and assess, what sort of future do these companies have, and are they actually going to be around to have a future anyway, as we move through the crisis. So it's a matrix, and on the vertical axis, we're looking at financial resilience, and on the horizontal axis, we're looking at how growth could be impacted by the coronavirus. Could it accelerate or could it be adversely impacted? And where you want to be on this map, on this matrix, is ideally in the top right-hand corner. And in the top right-hand corner, you can see a handful of stocks, which are typically in the digital space, such as Alibaba, the giant platform, Wix, the Israeli-based website builder, things like that. So that's a good place to be. I just want to note 3 in the bottom left: Aston Martin, the luxury car builder; Rolls-Royce, the aero engine manufacturer; and the FCA, which is Fiat Chrysler Automobiles, the auto manufacturer. These are all capital-intensive industries, and all been not wiped out. That would be an exaggeration, but severely compromised by the coronavirus. No one's flying, no one's buying aero engines, no one's driving, no one's buying cars, particularly luxury cars. So Aston Martin, you may have spotted on the previous slide, was a sale, and we've just decided that one's, the future for that one is not good. We think that the growth prospects have been severely impacted by coronavirus, and it's pretty highly geared. In fact, it had to have a capital, and it had to have a rescue by, I don't know if you follow Formula One at all, a guy called Lawrence Stroll, a Canadian guy who's the father of one of the top Formula One drivers. So we've sold Aston Martin, and Rolls-Royce and Fiat Chrysler are 2 stocks that we continue to think very hard about their place in the portfolio. But the key message here is the portfolio is in good shape, both from a financial point of view, as you would expect, because we invest in well-financed companies anyway, and also from a growth dynamic. So we're happy with the shape of the portfolio in that context. If there's no questions for me right now, I'll hand over to Andrew to take you on.
Actually, this is John Bishop. I've got one. Obviously, when you're dealing with one legacy companies like Rolls-Royce and a lot of the high growth companies like Ambu or so forth, how do you guys go about evaluating the capability of the management to either defend a legacy company and kind of work through the challenges that are faced by COVID impacted companies? And then how do you, a hyper-growth company has its own challenges. So I'm just kind of curious, how do you guys evaluate the management team, and are they up to the task? So just a little insight would be appreciated.
Yeah, no, it's a really interesting question, because actually that's the key point for any company. I mean, there's all sorts of things that impact, a company, politics, currency, trade wars, whatever. But ultimately, in the long term, it's about the quality of the management and the strategy that they have in place and their ability to execute that strategy. So that's what really matters. Let's take Rolls-Royce as an example, which is a company in a difficult place through no fault of its own. It's not its fault that this virus got out and people stopped flying. A chap there called Warren East joined the company about 5 years ago from a company called ARM, which was a silicon chip software designer, which was actually holding the portfolio before it was taken over by, was it Hewlett Packard or was it Intel? I can't remember. Anyway, it was taken over. Our instinct is to back management, and when times get tough, to back them and support them, because all companies go through tough. That's just a fact of life. So we're not going to cut and run a shareholding just because a company's in a bit of a cyclical downturn. Warren East put in place a sort of cost remedy program at Rolls-Royce, and we were backing that. We think we've run out of road there. Probably, I'm kind of slightly preempting what may happen. It's it's a company that's kind of on the cusp of being sold, to be frank. And the reason is that this crisis is so severe, and the company's in such a difficult place that we don't think the management's really got a chance of getting it right now. It's been at it for a fair time, so that's why we're probably going to sell Rolls-Royce. But when you think about the management, it's about are they the key points are they long term? Do they invest for the future? Are they willing to take risks? What sort of culture does the company have? And to get inside that, we like to see a whole range of people at companies. We spend a lot of time getting to know companies. We don't just meet the CEO. We don't just meet the CFO. We meet as wide a range of people as possible when we're doing our research to try and get inside a company and understand what makes it tick. So it's really the soft factors, John, as opposed to everyone can do the number crunching, but in terms of management quality and our assessment, it's about these softer factors. Slightly rambling answer, but I hope I've kind of made some sense there.
No, you have.
Any other questions on the slides we've seen so far? Okay, well, we're delighted to talk to you about the extra material in the pack. And the next slide on page 4, we've called the Great Acceleration of E-commerce. And the idea here, the concept here is familiar to everybody. We went into a lockdown with COVID around the world, and the inevitable consequence of that, I guess in hindsight it's inevitable, is that it was a massive surge in the rate of e-commerce transactions and penetration around the world. So online shopping became a habit for all of us. And we all knew that, but we just thought it'd be helpful to look at the scale of it and sort of show how that's really panned out in terms of numbers. So we've got some data on the UK penetration rates and the US penetration rates, where we are and where you are, as a proxy. I mean, these numbers will be slightly different around the world, but the pattern's the same. Historically, we've had this underlying trend, this tailwind towards more e-commerce penetration over the years, very gradual, and that's what we've been investing behind. But when lockdown kicked in, we saw this massive surge in online shopping and penetration. And obviously that net aggregate number masks quite a lot of variation. Demand for travel services being bought online obviously fell through the floor, as did demand for lots of luxury products. But at the same time, general e-commerce and groceries as well would have grown by much more than that number. Obviously, we don't expect the peak that was reached in the height of lockdowns to stick long term, at least for now. But we think surveys suggest that much of these gains will remain for online penetration. And there's some areas where we think we're really excited about in terms of what the scope of the growth could be. One of those being food as a concept, both in terms of meal deliveries and in terms of groceries. During the crisis in the UK, online grocery penetration went from 7 to 13%. And that sort of scale change meant that online grocery deliveries, which had always been deemed more convenient, also became cheaper for the companies that could do it in the right way. So an extra driver for the reason for consumers to shop online. So we spoke to the CEO of Ocado, Tim Steiner, and he said to us that they'd seen 15 years worth of growth in just 15 weeks. And at one point, their website was seeing 100 times the amount of its normal traffic on the website. They thought they were actually under a cyber attack at one point, but it was just a demand surge that they were seeing from consumers. And they've still to this day got a wait list of people who want to get onto the service but can't because they've not got the capacity to serve it all. For us, we've started by investing in Ocado, I think it was 5 or 6 years ago now, thinking that one day the crazy blue sky case might be that we get to 40% penetration in online groceries in the UK. The CEO of the company is now openly talking about getting to 75 or 80% penetration in online groceries. Not today, not tomorrow, but as a realistic outcome long term. So our crazy blue sky is just been doubled by the CEO in terms of what the vision could be here. And that's an example of a company that has almost doubled in share price over the last year. But we think actually our blue sky valuation of it has actually, gone up in spite of the rise in the share price. We've added to Ocado over the last year, as you'll see on the front of the portfolio holding slide, during the period where the share price was going up. And it might sound like a bit of a tangent, but actually Ocado is quite an interesting test case for you guys in Gainesville. They're selling their smart platform software and infrastructure facilities, or licensing that sort of technology to other supermarkets in different countries around the world. In the US, their partner is Kroger. I understand that the US supermarket sort of landscape is quite fragmented state by state, and in Florida, I think Publix is the biggest supermarket brand, and Kroger's coming into Florida now, and they've actually broken ground on their first customer fulfillment center for this smart platform in, I think, 90 miles south of Gainesville in Groveland. So you might see a bit more of Kroger offering online in Florida or not too far from you, and it's the Ocado smart platform that's powering that. So our fingers will be crossed that it works well. Obviously, the slide's got another chart or two there. The second chart, these are projections made externally, not by Bailey Gifford, so take them with a pinch of salt. But the point is, we've been asked a fair bit about, have some of these e-commerce platforms not sort of reached peak valuation, and should you not be selling out of them now? The point is, there's a huge amount of growth to go here in terms of the e-commerce opportunity runway ahead of us. We think some of it will happen a bit faster now that the COVID crisis has changed our behaviours, but the runway remains long. So the compound average growth rate forecast for the next 4 or 5 years is still pretty strong, and actually incredibly strong in China, where it's over sort of 9% CAGR there. And the important thing there isn't just the CAGR, but it's the scale of the market that growth is occurring in. In China in 2019, the e-commerce revenues were $860 billion US, compared to 340 billion in the US or 75 billion in Germany. So the scale of that growth is the thing that really impresses us. And you can see some of that growth rate coming through in terms of the portfolio holdings. The Q2 2019 to Q2 2020 numbers are given at the bottom of the slide there for some of our holdings in revenue terms. So in food, HelloFresh and Delivery Hero, HelloFresh was up 123%. In retail, Mercado Libre was up also by 123% year-on-year revenue growth. So some really impressive numbers there in terms of what's happening in the portfolio. And that, to reiterate Kevin's point, is one of the key drivers that's led to the positive portfolio returns we've seen in the fund that you're invested in. I'll pause there because there's one more slide that takes a bit of a step back, but I just wonder if there's any questions on that.
This is William. I just had a small question. The British e-commerce penetration, it looks like from maybe June or a little prior to June to August, you saw a reduction. What would you attribute that to?
Thanks, William. Yeah, so the UK numbers there we're getting on a monthly basis. So we've updated the chart to the most recently available data. The US ones are quarterly, so the data is a bit static to June there. I expect that across the world there will have been a peak at around sort of the June time when the lockdown was still in force, especially in Europe and in parts of Asia, and people had the chance to evolve in their behaviours and get online. So that June point was probably kind of a high watermark, at least for this year and the next couple of years. We expect the long-term trend to continue, but as the lockdowns eased in the UK and Kevin and I were allowed back out of our houses and shops started reopening, it's inevitable that some of the e-commerce activity would lessen, and it'll continue to do so to an extent. I wouldn't be surprised if the September, October, November numbers trickle down from where they are now. Some of those gains will be given back, but we think we'll end up at a higher place than we would have been if it had not been for COVID. And many people will have tested the system now, and once you've tested the system, you start to realise the efficiencies you can get out of it. So that reduction is just a function of the lockdowns easing in the UK. Okay, I'll step into the next slide now, but obviously happy to take questions on any of the comments Kevin and I have been making. And the ambition with slide 5 really was to take a step back and if we can put COVID to the side for a second, and it's 2020. It was the end of we're into a new decade now. So let's take a big picture view and see where we've come from over the last decade in terms of the portfolio and in terms of what we're trying to do for you. The 3 points being made. The first is that our core contentions and what we're trying to deliver for you in portfolio construction really haven't changed much over the last decade. You've heard our story a lot over the years, and it's the same one. The thesis behind the portfolio is still geared towards technology as being the thing that's changing the world. The early narrative on that was selling books online or CDs online. It's much more than that. Moore's law, the continual reduction in the size of a chip, semiconductor chips, is driving change in everything from agriculture to finance. If you we bought Baidu and Tencent, the Chinese tech names, in 2008. We actually just sold Baidu for you in the last 6 months, but we were investing in those sort of companies 10 years ago, and that's been a continuous theme in the portfolio. Likewise, China, Baidu and Tencent are Chinese names. We've been excited about China for more than 10 years. The early play on China was around the infrastructure build out, the build out of airports and motorways and infrastructure. But more recently, that's evolved into the consumer story, the massive increase in consumer spending in China. So we will have told you last year that we opened our first overseas research office in Shanghai. That was a year ago. We've been really pleased about the way that office has evolved and the production it's creating in terms of new insights and connections across China. And likewise, our conviction that when investing in growth stocks, it's only a few exceptional companies that really matter and will make a difference in terms of portfolio outcomes. So we've shown you our asymmetric returns chart many times. We don't have it for you today, but that's a picture of Hendrik Bessenbinder on the graphic at the bottom left there. And he's shown us that this skew in where returns comes from is true not just in our portfolios, but in equity markets in general. And we could talk to you at length about that topic, so I'll pause there. That being said, whilst those contentions that have been unchanged, the portfolio has obviously evolved quite dramatically over the last 10 years to reflect the changes that have happened within those themes. So there's four sections there: food, energy, healthcare, finance. Our portfolio exposures to these themes has changed significantly. In food, we used to own a wide range of traditional sort of supermarkets, Tesco in the UK, BIM, Dia in Europe. We don't own any traditional supermarkets in the portfolio anymore. It's all about new forms of food delivery. So there's holdings there such as Delivery Hero, HelloFresh, Meituan Dianping, Ocado that I talked about. We're really excited about the way that space is evolving, and you can see rapid change in behaviours amongst consumers. Likewise, in energy, we used to own traditional oil and gas companies, BG Group, Woodside Petroleum, etc. We don't own any traditional oil and gas companies anymore, nor have we for quite a long time. But we do have holdings in for our segregated account clients who allow us to have a small allocation to US stocks. We've owned Tesla for a long time. In your portfolio, we own NIO, a Chinese EV company, and Umicore, which is a materials company heavily involved in making batteries for lots of functions, including electric vehicles. So there's been a big shift in the way we look at the energy world. And I could say the same things about healthcare and finance, so we can go there if you want, but I don't want to bore you to death. So that's the evolution that's occurred in the portfolio in terms of how we're positioned around our core theses. And then finally, I really wanted to just demonstrate and evidence that we're still doing for you what we said we would do for you over 10 years ago when you first invested in the fund. And that's looking at the type of company that's in the portfolio, and that these really are ambitious growth companies. So the first chart there is about a capital allocation. It's a metric where we've got the portfolio versus the index, which looks at, in aggregate, capital expenditure minus depreciation, plus research and development, divided by buybacks and dividends. So it's looking at whether companies are taking the cash flow and reinvesting it internally, or if they're taking that cash flow and giving most of it back to shareholders. And I'm pleased to say that the portfolio is actually reinvesting money because it's a +1 number, whereas the portfolio companies are typically spending most of their cash coming back, so most of their cash back to shareholders. Likewise, on the earnings growth side, you can see the bar there, the portfolio earnings growth at 15% per annum in aggregate. That's 5 times higher than the index. And equally on the gearing or kind of balance sheet quality aspect of the portfolio, this is a portfolio of very high quality companies with very little debt. I mean, that's partly because we don't own any banks, so that obviously helps. But this portfolio is almost net cash compared to an index which is very heavily indebted, and that's been especially helpful in the current climate with companies going into the COVID crisis. So hopefully those sort of big picture, taking 10 steps back and looking at the portfolio, hopefully those perspectives are helpful in terms of what we've been trying to do for you and how the portfolio has evolved over the period.
Very good. This is John Bishop. I have one question. It has to go with the expensing of R&D, which I know specifically in the U.S. it's an expense, and there's a lot of debate, or not a lot, but there is some debate growing about whether that should be, an expense or an investment. So I'm just curious, when you're looking at companies, there are R&D expenditures. How do you view that, and how are you adjusting that in terms of the standard accounting rules? I don't know if that makes sense to you.
Yeah. Well, yeah. I mean, I have you'll be immediately beyond me in terms of the accounting nuances, and I have read about the papers historically about the way that the treatment of R&D can be used as a form of not engineering your balance sheet or your financial statements. But yeah, I guess we don't really take a view on the right or wrong ways to do this, and we when we're looking at specific companies, of course we'll try to look at whether and how companies present themselves financially, and as to whether they're being at all disingenuous. And that would just be, I couldn't make any broad comments on that. That would just have to be on a company basis. I think depending on the company, you can make, different kinds of arguments as to the right or wrong of that. And of course, we'd expect companies to be following the right GAAP or other accounting standard rules around this. But what I would say is that, on the concept of research and development, we typically want companies to spend a good amount on investing in this area. We don't want companies to throw money away and overinvest if it's nothing profitable to be achieved. And we have seen companies, sort of doing R&D sort of for the sake of it in places. But we broadly think where companies have an opportunity that they can exploit, we want them to fully exploit it and not to be worried about what the market might think about depressed margins or unpredictable earnings. We don't want companies to worry about that. We want them to go ahead and spend the money regardless if they're the concerns. As long as they think that there's an opportunity to exploit, we want heavy R&D investment in the right spaces, ambitious and bold management teams. I couldn't really provide you with much more comment on the accounting nuances because I think it really depends on company by company. This is the not we get into with accounting, because it's a broad set of rules that have to apply to a very diverse sort of set of companies that have to apply it. So apologies, I can't be more of an accountant for you on that one.
No, I appreciate the response. That's great.
Yeah.
Any other questions from board members or staff?
I just had a quick question, and I know it's not part of your process to certainly select companies based on currencies, whether it be the dollar or otherwise, but just given how you're looking all over the world, how do you view sort of the current environment of, say, the US dollar relative to the rest of the globe, and sort of, well, do you have any sort of estimate or where you think things might head? Again, I understand it's not dictating how you're investing the portfolio, but just kind of given your global positioning, if you had any sort of thought or opinion as to where that stands.
Well, I don't have a very good answer for you, Brendan. I'm sorry, it's not a point that we've had discussed in detail. I mean, Kevin might have some more nuanced reflections, but I guess our view is, as long-term investors, we tend to think and kind of hope that a lot of these things will wash out over time, and they might be very long time horizons. It could be more than our standard sort of 5 to 10 year time horizon when thinking about returns or holdings. But these things kind of go in cycles, and we're not best placed to sort of predict or comment on those. We don't spend too much time thinking about that. Obviously, macroeconomics is kind of stretched right now globally, but that it's not really a big factor when we think about making an investment, because we sort of think a lot of these things will come out in the wash long term. I don't know if Kevin would add anything to that.
No, I would simply endorse that comment and just actually refer to something I said earlier in response to John's question about management and management quality, ambition, boldness, as Andrew said, is in the long term is a much bigger factor than currency swings. And when we look at our research notes and talk to the investors, it just doesn't feature as a key dynamic.
Great, thank you.
I don't want to preempt any questions that you may have as a group, and please ask us more. But before we possibly come to an end, I wanted to just touch on a topic that we raised with Brendan and with Brian last year, when there was a small change to the to the fund's emerging markets allocation. So the fund was formerly benchmarked against the MSCI EFI as a primary benchmark, and a secondary benchmark was an ACWI ex-US benchmark. Last year we switched the benchmarks around. The primary benchmark is ACWI ex-US now, and there was a small increase in emerging markets exposure in the fund as a function of that, and scope for that to kind of tick up a little bit over the coming years. So currently the emerging markets weight is 27% in the fund. I could envisage the number increasing gradually over time. We've been very encouraged by the research that our Shanghai research office is producing. We understand the wider portfolio picture across the shareholder base in the fund, and nobody wants this to become an emerging markets fund or a by and large emerging markets fund. So something in the low 30s, I think, is a kind of conceivable level of emerging markets exposure that could happen over the next 3 or 4 years. And I just wanted to make the committee kind of aware of that and make sure we were also aware if you had any concerns. I know you have other managers in the plan that you have to try and think about the overall plan allocation. So keen to hear if you have any comments, and we'll want to keep that conversation open with you so you're kind of aware of how things are evolving.
Okay, great. Thank you very much for that comment. Any more questions from the committee or staff before I let our friends depart for the rest of their day or evening, whatever the case may be? All right, seeing no more questions, gentlemen, as always, thank you very much for a very thoughtful and informative presentation.
Thank you all very much.
Okay, very good.
Thank you.
Thank you.
Bye-bye.
Bye now.
Okay, we have next presentation from ANCO and Brendan. So Brendan, the floor is yours.
Great. Well, good morning, everybody. Hopefully you have a copy of the 9:30 report in front of you. I can share my screen if that would be helpful. But if you all have a copy and would prefer to just page through it, that's certainly fine too.
I have a copy. Would anyone prefer to have a shared screen?
I have a copy.
Great. I think we're good then. We're going to go ahead. We'll talk from the copies. Thank you.
Great. Well, I'm going to start on page number 5. Just kind of a quick review of the markets. Just kind of want to highlight a couple things. Obviously, we've been on the phone a bit, but not really talking about what's been happening. Certainly in the last 90 days or through September 30th, there was actually very little that took place, kind of newsworthy anyway, in the markets. Certainly, we had a ton of activity in the first quarter with all of the COVID-related disruptions, Fed activity, liquidity programs, stimulus package by the Fed or the federal government. But really here from July 1 through September 30th, it was remarkably quiet. There really very little happened other than the Fed, had made continuous remarks throughout the summer, essentially saying that if COVID-19 or other issues were going to be problematic for the economy, that they would, do more if necessary. So I just think that sort of underpinning or that backdrop has been something that's really helped the market kind of work its way through the summer, which is often a fairly volatile period. Looking at page 5, obviously we had a very good quarter with the S&P up about 9%, international less so, and then also positive results out of fixed income. But what I really wanted to highlight for you in the bottom right-hand corner were some of the deviations between, say, domestic large cap as measured by the S&P 500. So for the year, again, this coincides with the end of our fiscal year, the S&P and 500 was up 15%. International, as measured by the EFA or the ACWI, were up either 0.5 or 3%. And small cap by the Russell 2000 was up 0.4%. So really over the last 12 months, there was a huge variation. If you were a domestic large cap, heavy portfolio, you had a really good year. But if you had international and certainly some smaller cap exposure in your portfolio, it certainly did not perform quite as well. And then the second point, again, which you guys already know, but on page number 6, just the value and growth dynamic. Down in the bottom right-hand corner, you can really see this. I'll use the Russell 3000, which is the top part of that graph. Value was negative 5.7, and growth was positive 36. So a huge divergence in the last 12 months, again, which will obviously impact your portfolio because there are a number that have certainly that value bias. Really, the rest of the market information is relatively benign. I often talk about interest rates on page number 12, but quite frankly, not much has changed in the last 6 or so months. So with that, I'll kind of go ahead and jump to page number 16, where the results come together. And one little just sort of point of disclosure, what you'll see on this page is we do not have any universe percentiles. At the time that I had to generate the report and send it out, some of these kind of composite benchmarks, we didn't have any universes for. We do have some preliminary universes for some of the equity managers and the standalone strategies, but we didn't have them here. Again, for the quarter, 5.5 versus 6.6, so we're behind by about 1.1%. And obviously, you can see that trailing performance only by about 32 basis points over the 6-month period. But that does grow out over the fiscal year. Of course, this is the end of the fiscal year, so we finished at 4.61%, which was obviously behind the benchmark of 7.75. And obviously behind the actuarial assumed rate of return. Certainly, as you get out over the longer periods, 5, 7 years, continuing to perform very well above the assumed rate. But certainly the kind of the exposures that I had mentioned at the beginning, certainly international as well as some of the smaller cap and mid cap exposure certainly hurt the portfolio. And then again, just really quickly, if you flip over to page 17, you can kind of see some of those individual components. For the quarter, Twin was behind by about 1.8%, 7.6 versus about 9.5. That portfolio continues to struggle on that relative basis, being that enhanced index fund. Barrow Hanley was behind by about 0.5%, 5.05 versus 5.59. And for the fiscal year, negative results down 7% versus that benchmark of -5. Conversely, Brown, which is your large cap growth manager, 11.37 versus that 13. So again, relatively behind. But notice the absolute number for the fiscal year, 34%. So obviously a very nice return, but that did trail the benchmark, which was up a little over 37. Then you're in your smaller cap stocks with Pzena, 26 basis points versus the 2.5, and for the year down 16 versus a -14. Again, certainly highlighting not only that small cap relative to the rest of the market underperformed, but then certainly the value part of that market did that much worse. And then lastly, DGI, 5.3 versus about 9% for its benchmark, and for the fiscal year, 10% versus 23. So certainly quite a bit behind the index, and really those domestic, not only the allocation, but the relative performance is what drove the overall plan underperformance relative to the benchmark. As we leave our domestic stocks, we go to Silchester, who had a very nice quarter, 3.3 versus 1.2. And for the fiscal year, very nice relative performance. They were outperformed by almost 7%. But of course, that was in a negative environment, -5 versus about -12. And then Bailey Gifford, who you just heard from, has just been doing fantastic, 14.7 versus 8, and for the year, 53 versus 13. So not only in absolute terms, but also relative terms, just absolutely performing beautifully. Could not really ask for much more out of that portfolio. And then you have your fixed income with Loomis doing what it's supposed to, 84 basis points versus 62. And I guess somewhat surprisingly, over the last 12 months, given the low interest rate environment, we got 8.5% out of fixed income. I guess what I'll say is hopefully we don't get another 8.5 out of the next 12 months, because that means we're probably in for some economic difficulty. And then if you flip the page, the last piece is Principal Global. They were behind fractionally by about 20 basis points for the quarter. And then, of course, just fractionally behind for the year, about 1.25%. The good news is a lot of that money was pulled back before some of those write-downs and everything happened. So you had a lot less invested as the returns have come down. But we're starting to see a little bit more activity in the real estate market. So over the next couple of quarters, I would expect to see some more valuations and just more activity generally begin to pick up in that space. I'm going to pause there, see if you have any questions or comments on anything that we've covered so far.
This is John. I've got two questions. One's general, one's a little more specific to a manager. So overall, obviously we've hired these managers to play in a certain space. To your evaluation, are they all staying true to what we hired before? And then, yeah, go ahead. I'm sorry.
I was going to say, yeah, to that question, yes, that they are. We're not seeing any variation or deviation. Certainly, the thing that comes to mind are managers chasing the market, and the example of that was back in the late '90s, where you saw value managers, because they were underperforming for so long. Some of them started to buy the Ciscos of the world and things like that. But we're certainly not seeing that, and quite frankly, that's evident in the returns. You all of a sudden, if you're starting to see growth like number returns out of your value manager, all of a sudden you're saying, okay, did they just hit a couple of home runs with a handful of stocks, or are they starting to really style drift? But that's a long way to say no. That the portfolio has been very consistent, and we don't see any issues there. It is really just a reflection of kind of the momentum in the marketplace. The Amazons, the Facebooks have been dominating the market, dominating the S&P type returns. And if you didn't have market weights in those securities, you were behind. Right. It's just that simple. But the flip side to that is that doesn't go on forever. We saw for 2 weeks in September that those names got hit really hard. Value did really well for a couple of weeks, and then of course it reversed itself again. But we're starting to see that a little bit more. And at some point here, you're going to have that rotation out of growth and more into some of those value names.
Right. Well, I know recent comments from Steve Einhorn, and it was a couple of days ago saying he's very concerned about some of the large cap growth names that are again, everybody loves a winner, and the momentum has been going. That's great. The other specific question with Lumen's sales, could you speak to, given this rather odd environment we are in terms of fixed income and interest rates, how are they currently positioning their portfolio with regard to their implementation strategy? So Lumen sales.
Sure. John, I'll admit I don't have a lot of the most current statistics in front of you.
Okay.
Or in front of me, excuse me. If I could, I'll get back to you with some more detailed information, if that's okay.
Yeah, it'd be fine. Yeah, I mean, that's who knows what's going to happen with interest rates, but I think all bond managers are challenged right now. So I'm curious whether they're moving into more collateralized type of CLOs or they're shorting the duration. I'm just curious in terms of I frankly lost track of exactly what they're doing, and I'd be curious how they're navigating this strange environment. So thank you.
And just from a timeliness perspective, we actually are going to have them on the agenda for your next meeting in December. So we can also kind of hear from them as to sort of what they're seeing and any changes. It's one thing to get the static numbers of where they're positioned currently, but it's also another thing to kind of get some of that context for what they're seeing and how that might evolve in the future. Well,
given that, and thank you for that reminding they're coming up. Tell you what, you've done a yeoman's work here the last couple of months. There's no need to do any extra work. We'll wait to hear from the horse's mouth next meeting. So thank you.
Okay, very good.
All right.
So again, sort of for the sake of time, I'll stop there. If there are any other questions, again, certainly not the ideal fiscal year. Obviously when we were back in February and March and the plan was down, 11 or 12%. Certainly getting back to positive, what was certainly a win in most people's eyes, but obviously here at the end of the year, it is a little disappointing that the relative performance didn't quite get us to that hurdle rate. But again, considering where we were 6 months ago, I think it is certainly a positive that we got back to that 4.5% range or so.
Great. Okay. And Brendan, do you or William, would you prefer to speak to sort of our decisions for implementation that we agreed to at the last meeting? Could you give us an update on that?
Sure. I can give you a little bit of an overview, and then Brendan can also speak to it. We thought, given recent market conditions, we are down as of yesterday, close to, but not quite 5% from the date that we'd specified in the schedule as far as, maybe looking at moving forward some of the allocations. But, I think that given the committee's concern about market volatility around the election, I think that rather than moving forward right now, even if we I haven't looked this morning yet, we may have crossed the 5% threshold on the S&P 500. But even if we do that, I think it probably makes sense to wait until after the election to put any money to work. Yeah. So that would be our recommendation, I believe. But if the committee wants to discuss it or have some input, then that's fine.
I'm comfortable with maintaining what we agreed to is going ahead after the election. I mean, the VIX is trading, north of 40, so there's just incredible volatility. It's like trying to steer a small rowboat over seas that are 20 feet high. And you may be right, you may be wrong, but I think we'll have some clarity, at least, and hopefully financial markets, whether it's good news or bad news for their interpretation. I think that clarity and certainty will be helpful. I think the worst case is we have a contested election, and if that goes on for a couple of days, probably not terrible. If it goes on for months, I think the markets will probably not behave well. So I'm comfortable. Let's see where the chips fall after the election. And that's my personal opinion. Anyone else on the committee?
I agree with John. This is something we've got to see how this goes. We're going to know pretty soon.
Like it or not.
We're going to know pretty soon.
Yeah, John, this is Harvey. I do have a question. I'm fine with waiting after the election. That was my intent all along. I'd like to get the read on Twin. I know it's 2 years. It's kind of a short period of time. But across the board, they're behind their index about what the bond interest rate is. And have we not given enough time, or would we just better off to go to an index, pay 20 basis points or something? Just want everybody's feeling on that.
Yeah, I mean, I'll jump in and certainly say it's disappointing. We would have expected them to. I mean, certainly anytime you're deviating from the index, although it's not supposed to be by a lot, you're going to have variation. But it's been fairly consistent underperformance, and that certainly has been disappointing. We keep kind of looking at the same reason that some of the kind of like the value portfolios are underperforming is some of the same reason that Twin has been struggling. So we kind of have been looking to see that more complete market for them to have that opportunity. But you're right. Now that it's going on 2 years, for somebody that's supposed to be a lot closer to the benchmark, they've been under by quite a fair amount. And yes, you're not paying any management fees, but you could be getting the index for 2 basis points. So it's not like you have to pay a lot to get that index return if that was the ultimate decision.
Harvey, I agree with your observation. I think it's something we need to put on a watch list. I suspect, although I've not broken down the portfolio, that they're, as Brendan commented, they're sort of the victim of the skew in a lot of these indices. And I guess, sort of like we had a discussion about Brown, which has underperformed for a while. I suspect once not yet, or I guess if or when the indices kind of go back to some normal valuations, we don't have quite the skew. I would suspect Twin is doing better. And I guess if we were to relocate them or replace them, I'd rather do it after that big of a pop. But obviously, I'm guessing about the future. But it's certainly after 2 years, we need to be aware of it. Brendan, we have a Twin. It's not a huge amount.
Correct. Roughly
35 mil.
Yeah. Okay. That's actually okay.
Define huge.
So is that Dave?
Yeah, I say go ahead. Define huge. You said it wasn't a huge amount. But
Oh, no, I misspoke. I take care of 18 million in my head, but 35 was double. So let me retract my previous comment, Dave.
I'm more concerned about the 20 mil down with Loomis.
Yeah.
I mean, certainly in this interest rate environment, you're going to be hard pressed to find, some good returns out of fixed income, or at least I'll say this another way. Hopefully we don't get good returns out of fixed income.
I understand that point, and I agree. I'm just saying 20 mil may be, when we're in the midst of sort of readjusting here, we may want to look at somewhere, maybe 10 mil is sufficient in that amount rather than 20.
Well, I think what we had discussed is given the new liquidity profile and the fact that the annual cash flows are going to be higher from the fund, that actually, taking that up to about 30 million, which would be roughly a year worth of cash flow. So that way, if the markets were to go sideways on us, we wouldn't have to be forced sellers of depressed equities, and we'd have
Interesting. You must have had that discussion prior to my joining your board. I don't remember that.
Okay.
I mean, either that or, as usual, I'm an OCAMIC. I forget most everything.
So that was, in terms of like the first tranche of the POB proceeds, we were talking about putting, forgetting the exact number, it was $11 million into Loomis, and that when that question came up, why would we put that much into Loomis? It was to get it to 30 million, because that 30 million essentially represented 12 months of cash flow. So that, that it was sort of like the insurance policy. If the markets go sideways and the pension fund has to reimburse the city for its annual payments when it comes to close to September 30th, we at least would have that sort of ballast in the fixed portfolio if we didn't want to be able to, or didn't want to take any money from any of the equity markets.
I hate it when you're logical.
And as a side note there, Dave and everyone, I talked to Brendan briefly about this, and maybe we can discuss it in December when Loomis is here. But it might make sense to consider a shorter duration fixed income type of fund or management fund, given where we are with rates right now. That way, if you do see rates increase, you're not going to have as much downside potential as we would with the current fund that we're in with Loomis. So we'll look at that. There may be another Loomis vehicle that we can use, or there may be another manager. It would be easier if we could just change funds within Loomis and do something like that. But that's another alternative we can consider.
And I like that idea, William. I think discussion to add to their agenda. I mean, if you look at the producer price index inflation rate over the last 4 months, it's up about 6.1%. Consumer price index is up a little over 4%, and that's a short time frame of coming off the bottom. But again, if we get inflation in the system and the bond market start to react to that, I think a shorter duration fund will protect that capital better if we have to tap it, sometime a year from now. So anyways, I like that idea.
Well, if there are no other questions, the other item, and it really just is an informational and somewhat timely, given the fact that we've got the election in just a couple of business days, I included a couple charts related to the election, and I'm sorry if I had sent this to you previously. But again, what this does is it just sort of looks at the S&P 500 going all the way back to 1948 and sort of provides annual returns in election years, the year after the election, and also a little bit of a breakdown, sort of what tends to happen when the incumbent party wins versus when the incumbent party loses. Sort of the good news is, on average, they're always positive, but certainly when the incumbent party wins the election, there tends to be more of a positive response the year following. And again, that's highlighted on the first page. The second page kind of just goes into a further breakdown between who's in power in the White House, either Republican or Democrat, who's got control of the Senate, and who has control of the House. And then it kind of slices and dices all of the different combinations. So again, not trying to be predictive here, but just wanted to give you a little bit of historical, sort of insight as to, under the different combinations of control of government, and what the subsequent, S&P 500 annualized returns have been. They, of course, have been averaging 12.27 over that time. And then obviously there are some differences between, again, Democrats controlling House and Senate versus Republicans and so on. But again, I just wanted to provide that information. I thought it was timely given the fact that we're just about at an election here, and we should know some results, hopefully, rather soon.
Great. Thank you. Okay, and then it's interesting, who knows, but yeah, it does gives perspective. And perspective is always healthy. I don't see any other agenda items. Are there any other comments from board members?
This is Matt. I have been listening the entire time. Sorry, I haven't had many questions. I just, I was catching myself up on some of the conversations in background. So I appreciate, Brandon, you putting the agenda together for today and having the speakers. That was very helpful for me.
Great. And could you, the next meeting, that is December 17th at 9 a.m., correct?
That's correct. And the clerk's office is holding a meeting tomorrow that I'm going to attend where they're going to discuss the procedures moving forward for having in-person meetings.
Okay.
So there's a strong chance that we'll meet in person in December if the committee wants to. Right now, we expect the governor's executive order to expire and not be renewed as far as having a virtual forum available for public meetings. So assuming that happens, unless the Gainesville City Commission pass some type of a local ordinance extending that locally, then at least 3 members would need to meet. But we'll figure that out over the next couple of weeks and let everyone know what's going on, and we can determine how best to meet in December.
Great. And I have one just technical question. It has to do if somebody, a citizen or anybody else, was interested in joining the public meeting, which we're having now. Not that I have any requests, but I'm just kind of curious. How would they do that if ANCO sort of is initiating the call? It's one of my random curiosity questions.
If someone wanted to,
yeah, they'll say a citizen said, "Yeah, I want to pop on the call with CRC and listen to it." But what's the protocol for doing that? Is that possible right now?
Yeah. So I submit this meeting through the clerk's calendar.
Okay.
And it's published. It's a noticed published public meeting. And the dial-in number and or the link to the Teams meeting are both published.
Oh, good. Okay.
So anyone can use that and come into the meeting.
Okay, fair enough. Thank you. All right. And then, not that I have any questions, I'm just curious. Okay.
John, this is
yes,
Harvey. I'm still here. I have one more question about Loomis.
Sure.
Should we investigate what other products they have before our next meeting? Because if I remember correctly, when we hired them, it took a year for the attorneys to figure out who was right and who was wrong to instigate it.
Yeah, I'll work with Brendan, and we'll look at some of their other funds that are available between now and December.
That'd be great. Good.
Okay.
Thank you, Harvey, for raising that. That's a good point. Yeah. If you want to be able to make a decision, we're a slow-moving beast anyway, so anything to expedite decision-making is helpful. So that's great. Okay, one more final. Any other comments, questions, concerns? Seeing none, nothing we can address. Let's go ahead. I'm going to go ahead and move for closing of the meeting. I'd love to entertain a motion to close the meeting.
So moved.
All right. Do I have a second?
Second.
All right. Very good. All right. The meeting is now closed. Thank you, everyone. We'll see you either remotely or in person on December 7th. Thank you.
Thank you.